The owners of a running business manage to enjoy all the amenities of life that salaried individuals can only long for. And you know what? They operate tax-free.
Hello everyone, welcome to our channel. In this episode, you will learn the ground reality of how a business manages to operate tax-free as we embark on a captivity through the realm of taxation. And guess what? Our companion on this journey will be none other than a bustling grocery store. So, fasten your seatbelts as we dive deeper into the concept of taxation.
The purpose of this video is to raise awareness about business income tax. It is not intended to be perceived as tax advice.
So, what is income tax? Imagine a proud owner of a neighborhood grocery store, selling everything from fresh produce to household essentials. The store's earnings from all these sales represent its income. Just like you set aside a portion of your allowance for savings, the government also takes a portion of a store's income as income tax. Let's say our grocery store purchased goods worth $200,000 and sold them for $400,000 in a year. Then by simple formula, the profit should be $400,000 minus the purchase cost of $200,000, which is equal to $200,000. Assuming the income tax rate of 20%, $40,000 in taxes should go to the government. Right? No. The reality is much different from this. Do you know why? Because business can deduct almost all of its expenses from the initial revenue, which may even result in $0 in taxes. So, what kind of expenses can be deducted? Let's take the example of our bustling grocery store owner again, who is looking to navigate the world of deductions and credits to optimize his finances. Assuming our grocery store owner pays a salary of $40,000 each to two of his employees and $60,000 to himself. Now, for tax purposes, he is allowed to deduct his own salary and the salaries of his employees from his profit. And then, he's only liable to pay tax on the remaining amount after the deduction of salaries. So the total deduction would be $200,000 minus salary 1 minus salary 2 minus salary 3. This will bring our taxable income to only $60,000. The tax should now be $60,000 multiplied by 20% equal to $12,000. Right? Wrong. In reality, the calculations go way further than that, so sit tight and keep watching. Let's say our owner hired a consultant to keep his accounts straight. He also hired a marketing firm to help him grow his business. He pays them $10,000 each for this year. Then, $10,000 plus $10,000 is equal to $20,000. So, $20,000 can be deducted as a business expense. The deductions would now look like $200,000 minus salaries minus consultation services of $20,000. The taxable income is now $40,000. This is where it gets really interesting. Until now, we have been dealing with deductions that are in hard cash. However, we can deduct a lot of things that are either completely not cash, or the amount of deduction does not really match the amount of cash actually spent. In the world of business, money is not always equal to cash. Confused? Let's look into it. Let's say our store owner bought some store's equipment and fixtures, like those shiny cash counters and sturdy shelves. Such assets lose value over time due to wear and tear. This decrease in value is known as depreciation. Fortunately, the tax code lets you deduct a portion of this depreciation from your income over the useful life of the asset, resulting in reduction of the taxable income. In our example, say, $10,000 were spent on new shelves, and $10,000 more were spent on counters during the year. Let's assume they are expected to last 5 years. Then, for the next 5 years, our depreciation per year would be $20,000 divided by 5 years equal to $4,000. This deduction helps offset the initial investment and lowers the taxable income, ultimately reducing the tax bill. Again, this $4,000 per year is not hard cash, but it can still be deducted from the taxable income of the current year. So, our income sheet would look like $200,000 minus salaries minus consultation fees minus $20,000 divided by 5, $4,000. The taxable income is now $36,000. There is still more. Running a grocery store means the store owner would need to travel to different locations to make deals, hunt for better products, and transport goods from suppliers to his store. The costs associated with it, such as depreciation of vehicle, fuel costs, insurance, maintenance costs, and the rent and driver services of any vehicle used for business purposes such as delivery trucks, are tax deductible. Let's say the store owns a vehicle worth $30,000. According to the tax laws of most part of the world, business-owned vehicles are allowed to be depreciated over 5 years. Therefore, the tax-deductible depreciation for our shop owner would be $30,000 divided by 5 years equal to $6,000. If the fuel, maintenance, and insurance of the vehicle are total $6,000, then all of this amount can be deducted from taxable income of the shop owner. Meanwhile, our shop owner also rented a transporter for 5 days that costed $1,000 and took services of a driver that also costed $1,000. Our income statement would now be like vehicle depreciation, $6,000, fuel and maintenance, $6,000, and transport with driver, $2,000. Similarly, let's combine all the salaries under one head. Let us combine all depreciation amounts. We can clearly see this $10,000 is money, but it is not cash. Remember, it is a common accounting practice to combine expenses under one head, and there are standards and rules about how it should be done, but they are not covered in this video. Now let's say, the store owner manages some administrative tasks for his store from a home office. The expenses related to the home office, like a portion of his rent or mortgage, utilities, and even office supplies, can potentially be tax deductible. If his home office takes up 10% of his home's total area, he can deduct 10% of his rent or mortgage payments and utility bills as a business expense. Let's say the expenses are $10,000 per year. Its 10% would be $1,000 per year. Similarly, the shop's utility bills cost $10,000. So the expenses would be home office expenses, $1,000, and utilities, $10,000. Our taxable income has now reduced to $11,000. Now, just like the store owner would encourage his employees to save for their future, contributing to a retirement plan can benefit the store as well. If the store owner sets up a retirement plan for his employees, the contributions are typically tax deductible. Let's say the store contributes $5,000 in total to the retirement plan for himself and his employees. This amount can be deducted from the store's income, reducing the taxable income by $5,000. Furthermore, our grocery store owner decides to donate surplus food worth $2,000 to a local shelter. The value of the donated food would be tax deductible. The owner also decides to give $4,000 to a registered charity. So, the total deductions would be $6,000. Our final income statement would now be like retirement contributions, $5,000, food donation plus donation to charity, $6,000. Our store has made $0 in profit, so the business will pay zero income tax this year. In the case of our store owner, the 2 employees helping him in his store are his 2 daughters. So, their combined income is $140,000 per year. They get to enjoy a new car every 5 years, and their store pays for it. Similarly, the shop has sophisticated indoor climate control systems. The shop owner and his family spend most of their time at the shop in the ideal climate of their choice without worrying about the bills. In fact, the higher the bill, the lower the tax liability. The store owner and his two daughters support a common cause. They feel satisfied when their cause is helped. Therefore, they donate a generous amount of money for their cause, and yet again, it is charged as an expense to their business, lowering their tax liability. In a nutshell, the amount of facilities the whole family gets to enjoy by working on their business, and the satisfaction they get, significantly outlasts their salaries. Remember, these are just a few examples of the multitude of deductions available to business owners. For example, we have not included the deduction of shop rent, or in case the shop is owned by the business, we have not deducted the depreciation of the shop building. Just remember, each deduction has specific eligibility criteria, so it's important to keep detailed records and consult a tax professional to make the most of these opportunities. There are other taxes like sales tax, payroll tax, property tax and excise tax that we'll cover in another video. And there you have it, our in-depth exploration of taxes using the enchanting grocery store analogy. Just like items on the shelves, each tax has its own purpose and impact on the community. Remember, understanding these concepts can help you make informed financial decisions, whether you're managing a business or your personal finances. If you enjoyed this video, hit that thumbs up and subscribe for more insightful content. Until next time, keep exploring and keep learning.